Hello everyone and welcome back to Fun with Fitzy. Today's video is Chapter 9, Video 2. And now we're going to be talking about valuing accounts receivable. In the last video we talked about recognizing, which was mostly review from grade 11, so that was quite simple. Valuing accounts receivable is a process that we need to do to ensure that receivables are not overstated on the balance sheet. They are stated at their net realizable value. Now, this is a word that I want you to be able to remember because when we talked about depreciation, there's net book value that we need to show on the balance sheet. Well, in actual fact, for our accounts receivables, we need to state on our balance sheet what the net realizable value is because we're not always going to collect 100% of the money people owe us. It just is a cost of doing business, unfortunately. So what is net realizable value? Well, net realizable value is the net amount expected to be received in cash, and it excludes amounts that the company estimates it will not be able to collect. So when we talk about valuing accounts receivable, we're going to estimate what we think we're not going to collect, and there are a couple methods that we need to look at. Before we get into those methods, though, let's talk about the balance sheet and what this looks like on the balance sheet. This should not be a surprise to you because we've done this several times now before, but if this were a partial balance sheet, as we see here, partial, we know this is our current assets. We have cash here in our rightmost column, and then we have accounts receivable. We're moving it over to the left because we're going to do some math. So right now, currently, this company, Adorable Junior Garment, has $200,000 worth of accounts receivable, and they've estimated $24,000 is not going to be able to be collected. Now we're going to call this something called allowance for doubtful accounts. We are going to make an allowance for accounts that we think are doubtful to collect. We call it allowance for doubtful accounts. You need to remember that. So 200,000 minus 24, because we're subtracting it, this number is wrong, I'm noticing, is actually 170. Some of these slides from the textbook are wrong. So this is $176,000. So really, what we're saying is the net realizable value for our accounts receivable is $176,000. So I mentioned that there are two methods of accounting for uncollectible accounts receivables. The first one is called the allowance method, and the second is called the direct write-off method. The allowance method is the correct method, and the direct write-off method, although still used out there, is not a correct way of doing it. And I'm going to go through both. And once you see we get into this, there are two different allowance methods. One is called percentage of sales, and the other allowance method is called percentage of receivables. So let's go through them one by one. In the direct write-off method, no entries are made for bad debts. Now, bad debts are at the end of the year when we do our adjustments. We're going to estimate how much we're not going to collect, and we're going to call it bad debts. So under the direct write-off method, we're going to write things off directly when we realize we're not going to collect the money. So here it says, under the direct write-off method, no entries are made for bad debts until an account is determined to be uncollectible, at which time the loss is charged to a bad debt expense. So to put this in simple terms, you would be phoning them saying, you owe me money. And usually after several different phone calls and attempts to collect the money, you're going to finally realize that they're not going to pay. For whatever reason, they've gone out of business, they have no money, you're never going to see that money. So you have an expense now, and we're going to call that bad debt expense. And you're going to reduce the account. This is the direct write-off method. You're going to put it right to the bad debt expense account, and then you're going to credit your receivable. Now, no attempt in this direct write-off method is made to match the bad debt to the revenue or show the net realizable value of accounts receivable on the balance sheet. Now, this is a problem because let's say you made the sale in this year. Let's use this year. So this is 2013 now. So let's say you made the sale in 2012 and you have an accounts receivable of $100. Well, you don't find out until 2013 that you can't collect it. And now you have an expense, this bad debt expense. You're going to have an account called bad debt expense. And it's going to be $100. And you're going to credit this accounts receivable because you're writing it off. You don't expect to see it. You're bringing their account to zero, even though they didn't pay you. But instead of debiting cash, you're debiting an expense account. But this expense is happening in 2013. So you're not matching your expense in the period in which you earn the revenue, because you did earn revenue in 2012 here to match this. So that's the problem with the direct write-off method. It does not follow GAAP. It does not follow the matching principle. So here again is an example. So Piera Company writes off E. Schaefer's $200 balance as uncollectible on January 12th. They found out they're using the direct write-off method, and on January 12th, they found out that this company is not going to pay. So again, debit bad debt expense, credit accounts receivable for the amount of $200. Pretty straightforward. Again, the direct write-off method, not solid, not a good method to use. So, which brings me to the allowance method, which is the method that we should use. So here, and it's a little trickier, unfortunately, because you have to match your expense in the period in which you earn the revenue, but you don't know what your expense is. So for example, that example in 2012 that we just did, we had a $100 receivable, and we didn't know until 2013 that we wouldn't collect it. So now we're going to have to guess at the year end, or we call it estimate, what we're not going to collect in 2013. So there are a couple methods that we're going to look at. Okay, so the allowance method is required when bad debts are deemed to be material in amount. Okay, so we know big companies aren't going to collect all their money. And uncollectible accounts are estimated, like I just mentioned, and the expense for the uncollectible account is matched against the sales in the same accounting period in which the sales occurred. So in 2012, we made some sales. In this particular example, it was $100. And let's pretend this was a whole bunch of different customers. Let's say we had 100 customers and they each paid us $1. Just for simplicity's sake, we want to estimate that, well, maybe a certain percentage of these people aren't going to pay us. Maybe it's 5%. So in that case, then, we're going to have an expense called bad debt expense in 2012. We're guessing that 5% aren't going to pay us. So in 2012 at the year end, this is an adjustment, we're going to have bad debt expense for $5 because we said 5%. And we need to have an account here that we're going to credit, because remember, debits always equal credits. Unfortunately, however, we can't credit accounts receivable right now because we don't know which of these 100 customers, who are they, aren't going to pay us. So we make an account, that one you've already seen, called allowance for doubtful accounts. This is a contra asset. It's a normal credit balance. And we're going to put the $5 there. It's kind of like a holding tank. I call it a holding tank, because as people don't pay us in 2013, then we can then debit this account and credit the accounts receivable. So under the allowance method, here's an example again. We're going to estimate uncollectible amounts, and we debit to the bad debt expense, which we did in the direct write-off method, by the way. However, the difference is we're doing it in the proper year. So on December 31st of this year, we're estimating how much we're not going to collect for the sales we had in that same year. Okay, and so we're going to put it in allowance for doubtful accounts. Remember, allowance for doubtful accounts is a contra asset account, and we do this at the end of each period. Again, this is what we just showed on our balance sheet. This balance sheet is wrong. So just to review, our accounts receivable were $200,000. We estimated at the end of the year we're not going to collect $24,000. So our net realizable value on our balance sheet is $176. Remember, this number's wrong. $176,000. Okay. Now, when we actually find out who we're not going to get the money from, so in this particular case, it looks like we're found out from this customer, Nadu, that we're not going to collect their money. So we're going to now debit that holding tank because we didn't have anywhere else to put it. So we're going to debit allowance for doubtful accounts, and we're going to finally credit the actual account. This 500 is a credit. Okay, so actual uncollectible accounts are debited to the allowance for doubtful accounts and credited to the actual accounts receivable at the time the specific account is written off. So this is actually step 2. Step 1 was the estimate at the year end, where we actually debit the bad debt expense. You notice here that when we found out who we need to write off, we're not using the account bad debt expense. We're using allowance for doubtful accounts because we've already debited bad debt expense in the proper year because the sale was in the year before. Now, in some cases, when you write off an account, the customer somehow gets money and decides to pay you back. Not very often, but when this happens, you end up just reversing the write-off part. So in the last one, we debited allowance for doubtful accounts and we credited accounts receivable. Well, here we're going to find out this customer is paying us, and so we're going to do the opposite. For we're debiting accounts receivable back to put the account back in place, crediting allowance for doubtful accounts so we can keep track of what happened, and then we're going to record the cash that we got from them. So we're going to debit the cash and then credit that account again. Okay, so we're going to record this collection in the usual manner that we would have always done.